Well, hello out there in HFG land. My name is Casey Craig, and I'm the founding partner of Highlander Financial Group. And today we're going to go back and we're going to look at a little bit of history in the stock market. We've got a few charts here we're going to go over, and I think it's going to help us to kind of frame the overall idea of staying invested long term in the market. So as we know, uncertainty has risen this year because of the tariffs and the Fed policy, economic growth, artificial intelligence, a lot going on. Tech-related stocks have led the recent rally, but performance has broadened to many other parts of the market. So for long-term investors, I think it's important to maintain the proper perspective and look past this short-term volatility. So what we're looking at here on this chart is the S&P 500 going all the way back to 2016, I believe, and we were hanging out around 2,000 on the S&P, and we're up around 7,000 now, and we're up 16.3% year to date. So in spite of all this craziness going on around us, the market just continues to do well. You can see the 2016 election, the trade wars, COVID, inflation, and even all of the economic insecurity and tariff talk this year, and we're still chugging right along. So it does pay to stay in there long term. So on this chart, we're looking at stock market cycles in the NASDAQ since 1995. Tech stocks have been both up and down swings in the market over time. Tech stocks have been sensitive to economic uncertainty at certain times. Themes such as artificial intelligence have helped a lot of these tech stocks, including the group known as the Mag 7, of course. And then diversifying across asset classes and sectors is a critical part of long-term investing. But the Mag 7 and the Nasdaq in particular have led a lot of our success. We can see here in March 10, 2000, the tech bubble. And then, we're sort of seeing a bottom through the housing bubble peak. And then since 2009, 17 years and 8 months, we're up 1,770%, including through COVID and recently in the NASDAQ. So again, a long-term approach to investing does pay off for us. And of course, this particular chart shows annual stock market return ranges in the S&P 500. And this is one of my favorites. It shows annual returns grouped by returns, highlighting how often performance falls within each range. So historically, the stock market's been positive about 2/3 of the time. You can see positive 66 times, negative 32 times, and negative years happen from time to time. It's important for us to note that, but not to be fearful of it. So basically what we see is that, the majority of the time, the market returns between 0 and 30%. And then, when it's negative, most of the time it produces between 0 and negative 20%. But about 2/3 of the time, the market's up in a given year. About 1/3 of the time, it's down. So again, long-term, staying invested and not being distracted by the noise of the day is a key part of being successful as a long-term investor. So as always, stay tuned. We will keep producing content like this for you as often as we can. But I felt like this would be a nice way to just sort of frame up the volatility and the news cycle noise that we have in today's day and age, and just keep us focused on that long-term approach. We certainly do that at Highlander, and of course, as always, if you have any questions that come about as a result of watching this, feel free to give us a call. We'll be glad to sit with you and go over that conversation. So thanks, and have a great day, everybody.